Okay, welcome to topic 8, and this is how to calculate inventory benefits. Now, this whole series we've been focused on 1990s to today, so what's happened over the last 20 years or so, 25 years in the world of lean. I don't know that this has changed that much, but it's a topic that I think requires kind of a refresher every so often because people forget. And here's the number one issue that people forget, and that is that inventory is not a cost. Sure, products have cost. You have the cost of the materials that go into a product, but that's not the same as inventory. Inventory is the amount of material you have on hand in various quantities to enable you to build the products, and those show up in your financial records not as an expense, but as an asset. Okay, an asset, assets and liabilities. The problem with this asset is it's a kind of asset that don't do you no good until you actually build the product and sell it and get paid. So it's an asset, but it's not really generating too much in the way of benefit until you actually use it. And of course, if you don't have it, that's a problem too. So that's inventory. So if you reduce inventory, what happens actually is your inventory on the balance sheet, not your profit and loss statement, but your balance sheet goes down. But it has to go somewhere because remember, this is a balance sheet, so things have to stay in balance. So typically what will happen is you reduce inventory, but you don't replace it, right? You consume the inventory, but you don't need to replace it because you're flowing inventory at a faster rate. Your inventory turnover is improving. So what happens, you get paid, but that cash doesn't need to go back into inventory. It goes into cash, right? It stays in cash. So basically reducing inventory frees up cash. Now, freeing up cash is great, but again, it's not on the profit and loss statement. It's all on the balance sheet. So far. So now the question is, so that's one thing you can report, but when you report benefits from inventory reduction, let's say you go from 1 million to 900,000. You can't say that you saved $100,000 on your profit and loss statement. You didn't earn another $100,000. You simply converted $100,000 of inventory back into cash. So I hope we're clear on that point. Now, is there any P&L impact to reducing inventory? The answer is yes, because there are a lot of out-of-pocket or direct expenses or costs that are related to inventory reduction. For example, do you have to store it somewhere? And does that cost you some money? Does warehouse space cost you something, or is it free? Now, do you have to handle it? Do you have to receive it? Do you have to put it away? Do you have to cycle count it periodically? Do you have to pull it, right? Do you have to deliver it? So there are all kinds of costs related to inventories. And if the inventory level goes down, those costs can be reduced. There are a lot of other related costs. If you have the inventory around long enough, because you have too much, can it go obsolete? Absolutely. Can it get damaged? Absolutely it can. Can it simply expire? A lot of industries, you have materials that expire, have a shelf life. So if you have too much of that, that becomes a scrap. So there are a lot of direct costs associated with having inventory that do show up on your profit and loss. Unfortunately, it's not like a single line item on your P&L that says inventory savings cost or inventory usage cost. It's scattered among a number of different categories, but it's there, right? It's part of your profit and loss statement. So how do we measure it? Well, you're going to have to come up with an estimate of what that cost is. And it's somewhat a management decision. You can get your accountants, your cost accountants involved in trying to come up with this estimate, but it's a little bit of a strategic decision how high you make this percentage of your inventory. So what we're saying here is that over an annual basis, over a year, some percentage of that inventory that you have is going to be reflected in cost. And you need to set a percentage to reflect that. So that could be 5%, could be 10%. Just remember, the higher the percentage, the more importance you're giving to inventory reduction. And that can vary by industry. In some industries, that inventory goes obsolete very fast. In the computer industry, what I heard was the shelf life of some components is less than the shelf life of lettuce at the supermarket. In other words, you don't want to have a lot of this stuff around because it's going obsolete very quickly because the technology is continuing to change. So you as a company need to have a percentage, you call that the cost to carry inventory or cost of carrying inventory percentage. And when you have an inventory reduction program or measurement, you can apply that percentage to the difference, to the inventory reduction, and get some idea of your expected result on the profit and loss statement, but it's primarily for management type decisions. How much effort and focus do you put on inventory reduction? If that percentage is a higher number, that would encourage you to spend more time focusing on it. But you just understand that when you do reduce inventory, those costs are reflected in a number of different categories on your P&L. So it's a little bit hard to trace. Okay, so with that, I think I will leave you and we'll move on to the next topic. See you then. Bye.